In early August 2025, US President Donald Trump was navigating two major trade fronts at once. On one side, a 90-day extension of the tariff truce with China aimed to buy more time for negotiations. On the other, relations with Canada had worsened after a new 35% tariff was imposed on non-USMCA goods. Agriculture sat at the center of both disputes. Trump urged Beijing to quadruple US soybean purchases ahead of the truce's expiration, while Canada, once a top buyer of American grain, was moving to reduce its dependence on US suppliers. On Truth Social, Trump wrote that China was worried about its shortage of soybeans and that US farmers produced the most robust crops, calling for Beijing to quickly ramp up orders. With the US harvest weeks away, securing large Chinese purchases could stabilize prices and reassure Midwest farmers. For China, which has diversified imports toward Brazil and others, increasing US purchases could be a low-cost way to maintain talks without conceding leverage elsewhere. But Beijing now holds a stronger position than during the Phase 1 trade deal, controlling key inputs like rare earth minerals and specialized magnets vital to clean energy and defense. That gives China bargaining chips well beyond agriculture, potentially tying soybean deals to concessions on high-tech export controls. Meanwhile, Canada's importance as a grain buyer is shifting. Ontario has long been the top customer for grain from 35 to 40 US states, but higher costs at the border and a rising buy Canadian sentiment are prompting buyers to scale back orders from US suppliers. Any sustained decline in Canadian demand could push more grain back into the US market, pressuring prices and farmer incomes. While Trump applies direct pressure on China and Canada, Canadian Prime Minister Mark Carney is avoiding retaliation. Instead, his government is diversifying markets and negotiating quietly, blunting the impact of US tariffs while holding firm. The risk for Washington is that both China and Canada could scale back purchases at the same time, shrinking two of America's largest agricultural markets. The next 90 days will test whether Trump's dual-front strategy can deliver results. Tariffs have also taken aim at Canada's steel and aluminum sectors. As of August 1st, steel faces a 50% levy, the highest of any targeted product. These materials are critical to North America's auto supply chain, especially for high-volume vehicles like the Ford F-Series, which depends on aluminum from Quebec. Canadian steel exports to the US have already dropped by up to 35% for some companies, with factories idling and contracts lost. The uncertainty alone has frozen cross-border business. While Canadian exporters pivot toward domestic customers and long-term investments, the US auto industry is absorbing the shock. Rising raw material costs could push vehicle prices up by thousands, with some estimates as high as $9,000 for the most tariff-exposed models. Automakers can't easily switch suppliers, and the disruption is rippling through Detroit. Trump's August 1st deadline was designed to force quick bilateral deals. Some countries, including Japan, South Korea, and parts of the EU, agreed to expedited agreements. Canada refused, prioritizing structural resilience over short-term concessions. This approach contrasts sharply with Trump's blunt force tactics. As tariffs expand to over 70 countries, major US companies are warning of mounting losses. In the second quarter, General Motors reported $1.1 billion in tariff-related costs. Ford followed with $800 million. Stanley Black & Decker projects an $800 million hit for the year, and Apple has budgeted $1.1 billion for this quarter alone. Retailers like Walmart and Best Buy are passing costs to consumers, with price hikes now visible in everyday goods from shampoo to shoes. Even coffee may not be spared, as Brazil, a key supplier, faces new tariffs. In Canada, the 35% tariff on non-USMCA goods has cut total exports by 13% in the second quarter, with energy down nearly 20%. Alberta is bearing the brunt, along with auto parts and consumer goods. Rather than retaliate, Canada is strengthening ties with Mexico. Finance Minister François-Philippe Champagne and Foreign Minister Anita Anand traveled to Mexico City to reinforce trade relations with President Claudia Sheinbaum. With the 2026 USMCA review approaching, both countries see value in mutual support, especially as Trump favors bilateral deals. Notably, Trump granted Mexico a 90-day delay on additional tariffs but gave Canada no such extension. In 2024, Mexico accounted for only 1% of Canadian exports, but Ottawa sees room for growth. While Trump's approach is to apply pressure and count on US resilience, the economic blowback is measurable. In 4 months, the US manufacturing sector has lost 30,000 to 40,000 jobs. Carney's strategy focuses on trade diversification and long-term stability, avoiding the volatility of reactive policymaking. From cars to coffee, Americans are beginning to feel the costs of tariff politics. What began as a foreign policy tool is now weighing on corporate earnings, family budgets, and job security. Canada isn't waiting for Washington's stance to shift, it's building new partnerships. And that quiet realignment may be its most effective answer to the current trade storm. This is True State Report. Thanks for watching, see you in the next one.